Alright, good morning everyone as we head into European trade on Thursday, the 28th of September. Now we'll have a look across markets, we'll see what is going on, and we'll jump across to the charts and also see what is going on. You can see Nikkei post biggest one-day drop in a month, rate jitters way. Japan's Nikkei share average suffered its biggest one-day percentage drop in a month on Thursday as worries that US interest rates would stay at elevated levels rattle investors. I don't know if the word rattle is maybe the best word to be using at the moment. Markets have sold off obviously quite heavily in the last couple of weeks really, but over the last kind of few weeks. Markets have certainly not enjoyed the fact that they are waking up to the fact that interest rates may need to stay higher for longer. You can see the dollar steady near 10-month high, keeps heat on the yen. To the US dollar, US dollar still propped up, stocks still relatively under pressure, but we'll jump across to the charts and see it's not all doom and gloom in the last kind of couple of days really when it comes to stocks. You can see stocks green across the board in the US and in Europe, negative in Asia, driven lower by the Nikkei, which is obviously the Asian benchmark. Oil up slightly, again a bit of a draw on inventories out of oil yesterday, which we'll have a look at once we cross over to the calendar. US yields lower, albeit an aggressive move higher into the US session yesterday in yields has pulled back overnight. Caused a bit of a pullback in the dollar, but nothing too much to see in the dollar this morning. The trend is still up on that, and you can see across the board year-to-date percentage change, 3-month percentage change, month-to-date percentage change, week percentage change. Is just, it's like green across the board. It's blue here, but green across the board, positive across the board. Your Aussie and your Kiwi up in line with US and European stocks. The fact that Asian stocks or Asia Pacific stocks are down, you might want to see Aussie and the Kiwi down lower with that, but we are not getting that relayed across into FX. In this sort of analysis, you kind of risk sentiment markets, kind of cross asset correlations, not really playing out for us this week. Not sticking to the way they should, freely, because you're getting a lack of volatility across the equity markets. I would imagine you come across here and you have a look, US dollar pushing lower and back higher, certainly against the Aussie and the Kiwi. Euro dollar looks like it wants to make another attempt lower. Cable looks like it wants to make another attempt lower, and the trend is higher. The trend is higher on the dollar, and the trend is your friend, and you got to stick in line with that trend. Bit of a pullback for the Japanese yen, but it still just does look like it wants to go higher. Go up and test this 150. 151.944 was where they intervened in October of last year. If we just go back slightly and have a look, you can see that is the high posted back there on Friday the 21st of October. These are the sorts of levels that we're approaching now. Government intervention, central bank intervention, 150, 152, in and around this region is a place on the chart where we do need to be aware of currency intervention. Now, they've spoke about having a bunch of other central banks rally together in order to be able to help them and to sell a bunch of their currency against the Japanese yen. Does that result in movement across the board, or just movement in the yen? I'm not so. It obviously depends how much they go and buy and sell, but definitely a movement for the yen probably coming up. Do they actually follow through with it, or do they talk about doing it? And then does talking give us enough of a signal for this to push lower? I'm not so sure. We'll have to see. But 150, 151, 944, in between that range. Keep an eye out for any comments on the Bank of Japan. Is it likely to be tradable on the actual release? If you catch it early enough, here's a trade that you can look to try and take. Let's hope for our sake it does not happen at 2:30 in the morning. US yields, as I said, pushing higher in yesterday's session. They continue to push higher. That continues to push gold lower. Rising yields is negative for gold. Rising interest rates is negative for gold. Gold is a zero yielding asset. You make money on gold if the price goes up, right? Therefore, if you can get higher yield on other things like treasury yields, then there is less of a need to buy gold. If you can get higher yield and holding cash, is less of a need to buy gold, so people move away from gold when yields push higher. Oil continues its move higher. It's up above $95 a barrel, certainly in terms of WTI. The support level that we were looking at the other day held pretty well. that move then was pretty aggressive off it, but then continued on into yesterday's session with oil inventories yesterday. As you can see, I'm looking at Thursday. Help if I change that over to Wednesday, wouldn't it? We can see oil inventories yesterday, a draw of 2.17 million. Consensus was for minus 0.32. So supply continues to remain tight. Ongoing production cuts from Russia, Saudi Arabia definitely contribute to that pushing higher, and again, that's just another reason for oil to continue to push higher. Do you really want to buy it right up here at these highs? I don't know if that's a good idea. Bit of a pullback, maybe back to kind of 93 would probably be suitable for further upside. Economic data out of today, main focus of attention will be inflation out of Germany. Right, 4.6% consensus, so we're expecting a substantial drop. This is the total rate of inflation though, and oil prices do need to be taken into consideration. So do we get that much of a drop? Right, there's a lack of business activity in Germany, in the Eurozone at the moment. Is that going to be a contributing factor, or is oil going to be a contributing factor, and is that going to make it beat consensus? We'll have to see. But if that comes down like that, further reaffirms the stance that the ECB will not look at hiking interest rates again. May spark another fresh wave of dollar buying. I mean, looking for durable goods orders yesterday, maybe slightly negative, bit of a devil's advocate trade, but that came in positive again. US data continuing to surprise to the upside. GDP again today, consensus of a 2.1. It's a pretty strong growth in the quarterly figure. It is the final figure, so you're not going to expect it to be too far off consensus, but we'll wait and see at 1:30 what the GDP figures have to say for themselves and what that means for markets then going forward. And that means for equity markets, maybe a bit of a tricky one to read this week. Certainly since Tuesday, the equity market's just been chopping. You can see the S&P 500, Dow Jones, the Nasdaq and the Russell all not really doing too much, but maybe something worth keeping an eye on is these inverse head and shoulders across these. A bit of a messier one on the Dow Jones. I think it's away at the bottom of the chart, but a bit of an inverse head and shoulders across all of these equity markets. You know, if these necklines come under siege, maybe it might spark a bit of a short-term reversal. The path of least resistance is still lower on stocks, but people will look to buy these things, any available opportunity. You see the way they've moved over the last week or two. A bit of a pullback would not be out of the question. So keep an eye on that. And you get some weak data this afternoon, and might spark a move higher. But keep an eye on those necklines. Let's see what they have to say for themselves going forward. But 1 o'clock German inflation, 1:30 US GDP. Main focus of attention today. Do those inverse head and shoulders play out on the stock indexes? There's only one way to find out, and that is wait and see.